Partnered by Times Influence.
How does one navigate these volatile times? And I think that is the theme of Voyage 2018. What started as a dream year has turned out to be a volatile year. Macro concerns, global interest rate concerns, and fear of a tariff war surely has jolted financial markets. But rather than analyzing the past, it is important to dissect the future. It is important to focus on not where the puck has moved, but where the puck would move. And that is the idea of Voyage 2018. The finest fund managers and the finest equity strategists will really make a case for they will make a pitch and case for where the economy, where markets, and where things are headed both at the local and a global level. So let's talk about Voyage 2018 with none other than the three wise men of Birla AMC. Bala, Manish and Mahesh. Gentlemen, always fantastic to partner with you. You know, more than our viewers, I always look forward for the insightful sessions which always happen in Voyage 2018. Now Bala, too much of volatility. Everybody's trying to make a sign gesture just to capture the volatility, but what started as a dream year has turned out to be a very volatile year.
True. I think volatility, of course, is part and parcel of the market, whether it is in investment in equity, whether it's investment in fixed income. There are many variables that you have to track almost on an every year basis to see to it that your portfolios are constructed taking into account those volatility. Though the volatility we are talking about 2018 of different kind, the last when we started this investment voyage way back in the year 2013 and 14, we did have volatility and we were not knowing about the direction of the market. And that is why I think we said that as a Birla Sun Life, as an AMC, we need to actually set the ball rolling for each year as to what are the things that we look at both from macro and micro point of view, and which drive actually the investment sentiment, and through which how we can actually manage the volatility both in setting the expectations as well as on portfolio constructions. And that is why we started, and this year also is not different from that angle. And variables of the interest rates going up globally, and even in domestic post introduction of GST, how the tax collections are going to pan out, and how the macroeconomic variables are going to change, and so on and so forth. These volatilities are there. At the end of the day, no investments are made for one particular year. The investments are always made, whether it is in the business or whether it is individuals when they make investments on for themselves, or from while investing in mutual funds, they always look at long term. And while of course invest for long term, one need to be clued on to what's happening in the short term in order to understand and how they should go about managing their money. And that's why I think we at Birla Sun Life Mutual Fund see to it that we communicate every year in the beginning of the financial year on our view and how one should manage the volatility as we move forward.
Manish, now the bond market for last 12 months has been choppy. We can link it with rise in commodity prices or global central bank action. But for a bond bull like you, to convince investors that the best is yet to come would be difficult right now.
No, we're not bond bulls. You know, we got to modulate our portfolios basis how rates would kind of behave in future, and how to convince investors, of course, is that even in a year like this, when rates have been wobbly and have risen a lot, most funds, and we were discussing about it earlier, have actually delivered a reasonable returns to the investors. So a very small part of a portfolio of ours which actually invest in long dated instruments is where, you know, it's been hurt. Otherwise, majority of portfolios have delivered very thick real returns in last 1 year, and versus fixed deposits and other alternates that you had in the fixed income space, you know, the most fund houses have delivered a reasonable return. So investors are always and always better off, and in fact last year is the testimony of why you should always look at mutual funds, because irrespective of how interest rates play out, if fund managers modulate duration well, you know, they would kind of deliver you reasonable returns.
But the kind of returns what bond managers or bond fund managers gave, let's say in 2016 and 17 when the interest rates were falling. Do you think that kind of return expectation should not be real now? One needs to get more realistic because interest rates are likely to move higher or stay firm at least.
Yes, so there are two components of a mutual fund return in fixed income space. One is of course when bonds rally and you capture it by running higher duration, right? So that part of course is not going to be available to you on table when bonds don't rally. In fact, when they sell off, some of it gets cut out. The other significant part of a mutual fund portfolio is invested in carry, okay, and it delivers you same steady return every single year. So there are funds which would have delivered about 9.5–10% in last 1 year because the component of duration was amiss there, whereas large focus in these funds is only in carry. So given that majority of investors are invested in accrual centric portfolio for us and for most of the industry, a deviation in duration to the extent that we had last 1 year didn't really matter much to them. So yes, duration led returns would not be on table in next 1–2 years, but accrual would continue to keep you in good stead. But remember that even accrual itself is so significant today. Inflation outturn in next 1–2 years is likely to be between 4–4.5%, and some of our accrual portfolios are earning 10% on a run rate basis. So that almost like a 5–6% real returns. And now historically, if you were to see, worldwide, even equity delivers about 6–6.5%, 7% real return. So it's a investor's delight today to come in a fixed income fund and even passive portfolios earning them good 4–5% real return. So therefore there's always a case for investors to allocate more and more in mutual funds and fixed income.
Mahesh, 2017 in a sense had spoiled equity investors. There was no volatility and there were linear gains. Come 2018, the picture has changed. The macros have deteriorated. Political risk, which in a sense was missing, seems to be making a comeback. So what is the pitch for equities now?
Yeah, so you're right. I mean, this year we started off with more volatility, and after a sharp run, what we saw one way kind of a run last calendar year, we have seen a decent correction in the market. So while the macro environment has marginally deteriorated, as you said rightly, the good thing is that the micro is looking better now. So when I say micro, means bottom up. If you look at the earnings growth for the corporate India and companies, so that's looking better. In fact, after the last December quarter, we have seen that earning downgrade cycle, what we had seen earlier, has kind of halted. So we haven't seen any major downgrade to earnings. And a lot of sectors which were kind of underperforming, the outlook was weak, are looking better marginally from here on. I mean, whether it is the sectors like the pharma sector, the telecom sector, where you should see things bottoming out, even the banking sector, where we have seen a lot of pain, especially in the corporate banks. I think we will see the worst of that in this quarter. So, and we are seeing activity levels pick up across sectors, right from the infrastructure sector, the roads, urban infrastructure. In fact, a lot of the large construction companies are showing very good order inflows. Good pickup in the auto sector, both if you look at the last month numbers, it's really promising both at four-wheelers and two-wheelers. And even the commercial vehicle sector is showing good improvement. So I think we are at a stage where the economic growth, which had lagged for the last couple of years because of various factors. I mean, we had demonetization, we had the impact of GST. I think you will see these things normalizing in this year, and that should benefit. So I think while the macro headwinds, some of these could be there because of the global factors, but as the corporate earnings start to look better and improve, I think the market should be able to held on and scale higher as on the back of earnings and not purely back of liquidity, what we have seen in the last calendar year.
Bala, you've always maintained on different forums that 80% of the wealth is created by the right asset allocation. So I guess it's time also to revisit the basic asset allocation, because we've seen an up and down movement in the bond market. Equity markets have not exactly been very linear. Reserve Bank of India may be tightening, but for sure cost of capital in the world is going to move higher. How should one choose the average asset allocation in this kind of an environment for next 3 to 5 years?
I think clearly the one other thing remained it's a fact for Indian investors is a gross underweight on equity as an investment. So, therefore, the staying focused on equity as an asset class in order to get that what Manish mentioned about the real interest rate, real rate of return in equity is substantially higher than what is in other asset classes. So, that remains as far as the equity is concerned, and the power of compounding which we normally advocate that stays really powerful from the longer term investing point of view. Having said that, I think fixed income asset class also plays a very important role in every investor's savings pool. And most of the investors in India are used to investing in fixed deposit. Of course, that's easily accessible, and acceptance of deposits is far quicker, and understanding is also far easier, and therefore, most of them have actually stuck to that. At the same time, mutual fund fixed income scheme also is been playing a very important role, especially when you take into account not just only the return, even your tax considerations. So, adjusted for tax, if you look at the mutual fund can play a very important role in terms of managing their asset allocation strategy. And the asset allocations has to, as I mentioned, while one has to remain overweight on equity, given the fact that under penetration that segment is very high. At the same time, the pattern that I always advocate, when one of the recent article also I wrote, that one, there has to be a good mix between fixed income and equity, which could be anywhere between 50 to 50 or 60 to 40 towards equity and debt. And at the same time, within the fixed income asset class, there are many number of funds, as Manish mentioned about, have the characteristic of carrying the carry in nature, which is nothing but accrual of interest rates in the portfolio and some bit of interest rate volatility. I think the question what you talked about interest rate volatility, I think it does go through every 3-year volatile period. Then how do you play that? The anyway money managers does that, and within that I think one can easily put an allocation for long term within the fixed income. The same way on equity, and most of them people ask a question about should I invest in large cap and multi cap and mid cap. While of course we can keep giving a view which is more of each year view, at the end of the day if we simply apply the power of compounding, and as Mahesh mentioned about earnings growth can pick up. As the economy starts picking up, the earnings growth actually vary from the large size company to the mid size company to the small size companies. The earnings growth generally for mid size companies a little faster than the large cap company and so on and so forth. Therefore, that asset allocation also has to be well balanced between large cap, multi cap and mid cap focused. I think if we keep the very close eye on these asset allocations, and while of course market volatility will tell you which one we should go overweight, underweight and so on and so forth, but that is only a deviation. Maybe I will call it as needle change. One has just keep making it in order to get the long term strategy right.
So, just because the world has changed and the world could change, according to you the basic asset allocation should not change, and can that be the broader messaging at this Voyage?
Exactly. I think the last few years we have been I think highlighting about what are the risks that one will be running and what are the opportunities that we are seeing. At the end of the day, this year Voyage event also more focused on India is of course getting better for longer, both from the macro angle as well as micro angle. But each year we of course will go through some bit of ups and downs, volatility arising not just out of only on the economy in general, even the political economy also may go through some kind of ups and downs. But having seen all those things for last many number of years, what has remained constant and very powerful is the asset allocations.
Manish, long duration, short duration, what should be the right asset allocation in the debt market for this year? I mean, there's always this tactical move which investors would always look forward to. So, let me hear from you that where do you think there is a tactical case here?
I'll tell you what most investors are doing with us, and which is a general message from us to all the audience of our show, is that most investors do come for long term. India is a young country and most of us are savers. We're going to be extracting from our savings much later, maybe a couple of decades later. So therefore, most investors, try to hold on to anything that they own barring from few cities like Bombay and Delhi, where some of us try to opportunistically move allocation towards any asset. Whoever comes in our funds in fixed income space, and it's paradoxical that the seasoning, and Bala would confirm, seasoning in fixed income fund is more than equity. Why? Because of a variety of consideration. One is that it's so fixed income like that people don't feel like moving out. Okay, because this is an allocation which is very, very natural to them. As it was happening to your dad in a fixed deposit, it's happening to us in fixed income fund. Number two is tax consideration, that the tax incidence, if you stay put for 3 years, is significantly lower than versus if you kind of move out within 3 years. So that actually is also an obstacle for investors to move out. So therefore, the general perception that investors are moving around from one place to another is actually untrue. And it's so unbelievable that most of our funds, investors have been there for 3 years, 4 years, 5 years. It's of course growing, and which is why every year we adding AUM, but it's very likely that investors would stay put for very, very long. So now comes the question that where do people put money, in short duration funds or long duration? See, again, long duration play in fixed income space is bit tactical. That's the only tactical play we offer to our investors. These shows where we disseminate information with regards to how inflation would kind of play out, and therefore rate reaction function would play out. That part of the curve is tactical, so people should come in and get out also. But in most other funds, short, ultra short, credit centric, accrual centric portfolios, people have to come in for really long. So right now we are advising that large chunk of your portfolio should be invested in accrual centric portfolio, which are AAA centric, AA centric, A centric, depending upon your risk appetite. And given that the rates have sold off a lot, a small part of your portfolio, 5-10%, could be in funds like dynamic bond fund, which kind of do a dual role of actually investing a large part of your money in accrual, and some bit of a play in duration is also extracted from there. So a significant allocation towards accrual centric portfolios and a small allocation towards long centric portfolio is what we are advising.
You've been very specific, and Mahesh, I'm just going to throw that same question at you in a different manner. We've talked about allocation in large cap versus mid cap. You're making a case that 2018 may not be a great year for macros, but for micros, which is individual companies, you may get the right mix right. So is it time to now revisit a mid and the small cap fund, or still one should stick to large cap?
No, I think irrespective of the market, I think allocation, as Bala mentioned, I think we should stick to that. So mid and small cap kind of funds in the last 3 years have done very well. The valuations had gone up. So there was some amount of concern in the small and mid cap space, especially during volatile times, right? When there is volatility in the market, we see a larger correction, if at all, when the markets correct in the mid and small cap space. So to that extent, the risk in the small and mid cap sector in this time is slightly higher. But again, if you take a slightly longer term view, and as we believe that the micro is looking better, the Indian economy is likely to improve. So all these mid cap companies are domestic focused, and they should be able to see a better growth. So clearly over a 3-year time frame, the earnings growth for our mid cap universe is much stronger than the larger cap one. But having said that, at this point in time, the mid cap valuations are still slightly on the higher side. We've seen a decent correction in the market, even the large caps have corrected, and the risk reward from the large cap space from a near term perspective would probably look slightly better, because if at all there is some minor correction in the market, I think you will be better off in the large cap space. But somebody is taking a longer term view, and that's what typically we see equity investors coming into the market. So for them, I think the normal allocation towards mid and small cap fund, which would be around 25-30%, I think that should continue, because over a longer term, I think that can give a slightly better alpha than the larger cap funds. So I would say that from a tactical perspective, in the near term, a slight bias towards large cap would still be there at this point in time, but over a longer term, I think that really neutralizes, and one can really come back to the normal allocations, whether it is large cap, mid cap or multi cap. We don't see any reason to really favor any one of those at this point in time.
So Bala, if, before we conclude, just correct me if my interpretation is wrong. The broader messaging, I guess, for our viewers and at Voyage would be that the world may have changed, but for a long-term investor, frankly, nothing has changed. Stick to your basic investment plans. It could be crude next month, it could be interest rates, it could be a tweet from Donald Trump or something in local environment. But frankly, for a long-term investor, nothing changes. You should just stick to your basic financial discipline.
Exactly. I think that's a key message which always we keep giving from an investments angle. Again, go back to the last 15 years, 20 years. So much of uncertainties would have gone through, which could have driven the sentiment in the market, both in fixed income and equity. But ultimately, from the return point of view, it's remained more or less the same as normal GDP plus a few premium towards equity. At the same time, the real rate of return over the inflation on fixed income has been in the range of about 3 to 4%, and that's what it comes actually. So that I think one should keep that conviction on and stay invested, stay focused on asset allocations, and of course keep hearing your market volatility. At the end of the day, everyone like to actually track the various events that impacts the market, but listen to that, but ultimately come back and stick to the long-term investing principles, which is nothing but allocations, getting allocation right.
I'm glad you say that listen to the market volatility. He's not telling us that we'll be out of business as television channels. So, appreciate your time. Gentlemen, I look forward for these engaging conversations of Voyage. I'm looking forward to some global speakers and local speakers who are coming forward too. All right, good luck, and I'll see you at the, on the Voyage day at Sara Star. All roads, I guess, that day in Mumbai would be leading to that destination.
Yeah, thank you.
We all look forward to Voyage 2018 for the broader messaging to understand the thought process and what the top team of Birla AMC is really making of the current market environment.
Partnered by Times Influence.